Market expectations changed dramatically during the first quarter. The Trump administration rolled out sweeping trade tariffs in early April, sparking concerns about economic growth, corporate profits, and inflation. Now, the tariff plans remain in flux, however. The S&P 500 fell into correction territory in March, and stocks ended lower for the quarter. History may help investors interpret today's volatile markets because market patterns tend to repeat across different situations. Now, in February, less than 20% of the members of the American Association of Individual Investors were bullish. This reading was near the bottom of the survey's historical range, and it represented the fastest bull-to-bear reversal since the 1990 Gulf War. Now, sentiment indicators tend to be contrarian, and the AAII survey is no exception. Now, historically, the markets have fared well after bullishness in the AAII survey reached extreme lows. When the percent of investors who are bullish fell below 20 in the past, the S&P 500 rose an average of 20% over the next 6 months. Now, uncertainty around trade policy historically is another contrarian signal. An academic index of trade policy uncertainty jumped to a record high in March. Now, investors might worry that lack of clarity on trade policy will hurt stocks, but the historical data suggests the opposite. Since 1990, higher trade policy uncertainty has correlated with higher risk-adjusted stock returns over the next 12 months, on average. Now, meanwhile, the outlook for loan growth has brightened. The Small Business Credit Survey by the National Federation of Independent Businesses has improved, and historically, when that survey has improved, lending growth has followed. Now, loan growth has been historically weak this cycle. Acceleration could boost the markets, especially financial stocks. Since 1978, when loan growth has been in the bottom quartile of its historic range and accelerated, financial stocks have outperformed the market by an average of 3.3% over the next 12 months. Now, on the other hand, energy stocks continue to look unappealing. Energy stocks have declined since 2023, underperforming the broad market, and investors may wonder if this is a buying opportunity. And the answer may be no based on history. After other 12-month periods when energy stocks trailed the market by more than 15%, they kept trailing the market over the next 12 months on average. For more information about our views on current market trends and sector investing, please read our complete quarterly sector and investment research update at fidelity.com/QSIRU. Thank you.